Hi, I'm Giri Prakash from TheFederal. In today's Big Money episode, we will discuss about how youngsters, especially those who have got their first-time jobs in the 20 to 30 age group, are now looking at going away from traditional ways of investment like mutual funds and are shifting gears to uh, investing directly in equities and in crowdfunding platforms. For example, uh, for something as less as say around 5,000 rupees to as high as around 10, 20 lakhs. And there is a significant investment coming from this age group into startups, which makes it all the more uh, very interesting in today's scenario. Now, this is especially because of the kind of awareness that has happened among the youngsters and how they are now looking at various options. Earlier, the mutual funds and fixed deposits and even the life insurance corporations insurance plans, the traditional insurance plans were the ones which were good investment avenues for most Indian investors, offering a mix of safety, returns, and tax benefits. The Our older generation would go ahead and invest in, say, for example, post office accounts, but a lot more people have moved away from that. With the advent of technology and the proliferation of financial literacy, there has been a notable pivot towards more direct and potentially high reward investment channels. As I told you earlier in equities and funding platforms for startups. The issue is that there was an issue about how these investments are no longer safe, but people are willing to take a considerable amount of risk now. Now, this actually represents a very broader trend of financial empowerment and willingness to embrace risk for higher rewards. This shift not only reflects a change in investment culture, but also holds the promise of fostering a more vibrant and innovative economic landscape in India. As this trend continues to evolve, it will be crucial for investors, both young and relatively older, to balance the pursuit of higher returns with the principles of prudent investment to achieve their financial goals. So now let us look at each of the scenarios and how they play out. So let us look at the traditional investment landscape. We all know mutual funds is one, fixed deposit another, public provident fund is a third one, and you have national savings certificates, stuff like that. Now, mutual funds, they continue to be a popular choice, but people invest only when they believe that it will give me a bit of safer returns, and they do invest in them, but not all of it. Earlier it was most of it, but now they will invest in mutual funds, but it is at a far lesser lower level. What is the kind of returns that mutual funds give you? The returns over a period of time gives you between 9% and 12%, and sometimes 14%. But again, it's over a greater period of time. For example, 5 years, 7 years, and stuff like that. Fixed deposit, we all know, the interest rates keep going up and down. But while they are very, very safe instruments, their returns are very, very limited. A 6% or a 7%, sometimes uh, for the pensioners, it will be around 8%. But they are very guaranteed kind of returns, but they have conditions. You cannot break your FD earlier than the designated 3 years or 5 years. If you do that, you will get far lesser returns. So there is a risk involved there. All right. Once you invest in a fixed deposit, you have to run the course for 5 years before you go ahead and take out the money. Public Provident Fund, national savings certificates are again risk-free, but at the same time, the returns are very, very low. But at the same time, they give you a certain amount of tax saving benefit, and you can spread a bit of your money that you have into mutual funds and bit into PPF so that you get some amount of tax saving benefit there. So the other thing that is happening, the second scenario that's playing out very well now is the rise of direct equity investments. Investing directly in stocks allows investors to own a portion of the company, which is obviously true. There have been older set of people who have been investing for a long time and have use those dividends to for their livelihood or for extra income or what you call as the second source of income. And companies like Reliance Industries, TCS, HDFC, the blue chip companies, they've always been good. They have given better returns. If you have invested early, your dividends are more, and they will give you higher returns. And if you invest much later, they are more or less at their peak level. So your ability to actually get better returns becomes very limited. However, there are newer stocks. For example, I won't name the company, but then there are quite a few big ones where initially they did give a bit of a negative return of around 7 to 8%, but over the last 5 years, at least one company has given, sorry, not the last 5 years, in the last 3 years, they have given a return of 690%. And on a 5-year basis, they have given around 1,210 percent kind of returns. So there are such companies, and you have to be very, very careful where you invest. And those companies which give you these kind of returns, you should be quick enough to make money out of it and also withdraw whenever it is necessary. All right. Usually equities give you good returns. However, these kind of returns are once in a lifetime, and you have to be very careful about it. There's a bit of a downside there. Then there are digital platforms like Zerodha, Upstocks, Grow, GROWW. They have revolutionized access to the stock market, offering user-friendly interfaces for buying, selling, and analyzing stocks, and making stock market investments more accessible to the youth. So they are there, you invest in them, at the same time, you have to be very careful. You have to do a bit of, do your own research and invest wisely. You'll get very good returns, but if you do not invest wisely, if you do not know when to exit and when to enter, there are always issues there. You might lose a lot of money, right? At the same time, today, there are influencers, there are YouTube channels, there are people who actually give you investment advice and tell you what to invest, what not to invest. Finally, you're the person who is going to take risks, so better be careful about it. The third scenario is the crowdfunding platforms and startup investments. And this is the most exciting opportunity that is available right now. And the startup culture is at a high. There are a lot of investment firms which have invested heavily in them. And what is also happening is the new startups need money, may not be able to get into the traditional kind of, they can't look at investment funds, and they will be able to get only when they are in the second or the third round. These kind of startups are initially bootstrapped because the founders are, they use their own money to launch these startups. They're always looking for money, and they use this crowdfunding platforms to go ahead to get some amount of money initially. Now, which are these? For example, there are platforms like Keto, Mila, VFunder. Some of these social this is for social causes. Some of them are for crowdfunding stuff. This democratizes investment in early stage companies previously accessible only to venture capitalists or angel investors. Now, I'll give you a very interesting example, and you might be interested to know about how a single person was able to make a lot of money because he invested wisely. There was this person called Ashish Gupta, who was the first angel investor in Flipkart. He was the first investor. He invested 10 lakh rupees or 1 million rupees. And when he exited, when Walmart took over Flipkart 10 years later, he got a return of 130 crores, right? So his investment of rupees 10 lakh in the co-founders Sachin and Benny Bansal, when they're raising their first round from Axel Partners, where Ashish Gupta was one of the founders there in 2008, yielded him a return of 1,30,000% return, which translates into an astonishing annual return of 104% over the entire period. Rupees 10 lakh, which ended up getting him 130 crores. There are a whole lot of startups which have benefited from these crowdfunding platforms, and I will quote two of them, Chai Point and Bira 91. They are examples of startups that gained early traction and funding through crowdfunding and have since become well-known brands in India. These success stories have inspired potential investors and the youngsters who believe that they want to be part of the success story. They might lose a bit of money. They will be, for example, they might have invested in, say, 10 startups, and one of them will give them a very good return. But they want to be part of it. They want to be known, and it is a huge. So if the startup really does well, that encourages them to invest more in a whole lot of startups. What exactly is driving the shift, cultural shift among Indian youth? The Indian youth's growing appetite for risk in pursuit of higher returns is evident in their investment choices. This is partly due to the more dynamic global perspective and a stronger belief in the potential of emerging technologies and startups. Impact of startup culture, it has sort of touched almost every Indian. The success of startups like Flipkart, Ola, and Paytm have inspired a new generation of entrepreneurs and investors, making startup investment a more attractive and aspirational avenue. Almost everybody today uses the startups either to buy food, consume food, or to buy products, or for any other kind of services. So obviously, because there are various touch points here, people would also like to be part of that success stories. And of course, the influence of social media and fintech influencers. Social media and fintech influencers have played a pivotal role in shaping investment trends. Platforms like Instagram, Twitter, and YouTube have become key sources of financial advice and market trends, influencing young investors' decisions. The other thing that is happening, and one must take note of, is that traditional banks and mutual funds are now innovating to retain customers and offering digital investment platforms and more transparent products tailored to younger investors' preferences. As crowdfunding grows, it could significantly increase the amount of capital available to startups, driving innovation and potentially accelerating the growth of the Indian economy. I do hope this episode has been useful to all the investors, and there are several takeaways from this.
Subscribe to the Federal's YouTube page for more news and updates.